You, as the owner of the policy, get to decide what that dividend goes to. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. Today's subject is going to be the flexibility of the infinite banking concept, and more particularly the whole life policies that we use to practice the infinite banking concept. As I was considering this idea of pointing out the flexibility that is in properly structured whole life policies that are with a mutual company that pay a dividend, I thought about the story, and perhaps you've heard it too, about the palm tree and the oak tree. Both weathered a massive, severe storm, and the unyielding, strict, rigid oak tree, giant of an oak tree, was toppled over. Whereas the same winds, the exact same circumstances and situation had the palm tree to bend and to flex with all the gusts and the waves, and it survived the storm. Now, I believe that that is a good illustration to point out, because I would say that there are things that we could be rigid on, things that are natural laws, much like we would find in R. Nelson Nash's book, Becoming Your Own Banker. Some things that are just natural laws, and we hazard, danger or ruin, depending on what it is we're talking about, if we ignore those natural laws. But at the same time, the dichotomy is that flexibility can be very, very beneficial, especially to the owner-consumer. Now, particularly if we can get past the idea of where to do our financing from, where to warehouse our wealth, and we arrive at privatized banking, we arrive at a system of policies that we own and control for our need of finance, or even before. So what I'm saying is that this discussion will most certainly be for those that are still vetting the idea and they want to be aware of the benefits of flexibility, but also for those that have their first policy and they're getting ready to use their first policy for financing a vehicle or business purposes or investing or whatever it is that you may be wanting to use your policy for, or for the long time clients, users, listeners. Let's talk about flexibility for everyone today. So when we arrive at privatized banking, when we arrive at policies that we privately own and control, and we realize, of course, that the benefit of access, meaning that we can put our money somewhere where there is control, there's ownership, there's accessibility, there are all these different advantages that we have, wherein we are putting our capital in a place where it can grow, guaranteed. There's also a very high respectable anticipation of a dividend, even though that's not guaranteed, very high anticipation. Seeing as we could be talking about companies that have paid a dividend to policyholders for well over 100 years. I mean, what a track record. So when we get past comparing conventional entities to infinite banking, because you don't have to compare them in that they're not both investments. A conventional qualified plan, that is an investment to be sure. Owning a policy with an insurance company is not an investment. Now, with our imagination and with the knowledge, the logic and reason that we can use and apply to practice infinite banking allows us to see it as more than just what it is at face value. See what I did there? Dad joke. Face value. That's funny. That might make it to the bloopers. I might just keep it right here on the original cut here. But when we can get past figuring out where to warehouse our money, where to finance from according to the terms and conditions that we want to be subject to or not, the access that we are willing to abdicate or rather that we want to maintain, when we get to whole life insurance companies. And we can do any of those other things from the home base of a life insurance policy that we own and control. We could still go out and invest in real estate or a 401k or an IRA or anything else that we want to, because again, that's the point, is that we do indeed have access to our capital. And we have private ownership over that entity. So we're the first in line to get to it, and you could do that without interrupting the compounding. So let's talk about the proper structure of a policy then that makes the flexibility available to the owner. The place to start is actually going to be with the death benefit. Now, I know that traditionally that is all that is considered by the layperson when looking at life insurance, is just simply offsetting a risk and providing a death benefit to heirs or beneficiaries in the event of an early demise. And that is what insurance is. Insurance is the offsetting of risk. Now, with whole life insurance, you start to turn that offsetting of risk permanent instead of term, let's say. And then as you walk that out, you can continue to add specificity to what kind of whole life of insurance that you're wanting and get it properly structured for your intended purposes, which could include finance. And Nash does say in his book, our need for finance is greater than our death benefit. However, once you realize the relationship between cash values in a policy that you can borrow against to finance whatever it is that you're going to do anyway, by adding that one step of owning the policy, the cash value is going to be a net representation today of that future death benefit. So we can't have the cash value without the death benefit. So the death benefit is the place to start because it is pragmatic in establishing that death benefit because of the offsetting of risk naturally. But the amount of death benefit is also going to help dictate the availability of cash value that we can borrow against today. What I'm saying is get a policy where the cash value is squeezed down, the death benefit is squeezed down to nothing. Well, what's that going to infer inherently for the cash value? Now, I know that there are others that would say, especially when you begin looking into the infinite banking concept footprint, there are those that would talk about balancing the structure of a policy out to where it has massive cash value, virtually no death benefit. And what I believe is that if you walk that scenario out, if you are aware of what's going on, you'll know what to do, like Nash says. You can't get enough death benefit. I can't get enough death benefit. That will never be the case. No matter how many policies my wife and I end up owning in our system or you end up owning in your system, we can never have enough death benefit for many different reasons. For the death benefit, for the tax-free transfer of wealth, the number probably couldn't be high enough. Although we work towards that, we pay significant premiums so that we can have a significant death benefit. But also we pay significant premiums so that we could have a significant death benefit so that we can inherently then have a significant cash value that we can leverage for our needs of finance. So what I'm saying is it's very necessary to understand the relationship between the parts of a policy and the structure of a policy. They are interdependent. So in deciding on an appropriate death benefit should be based off of a lot of pragmatic information, such as your income, sure, your human life value, sure, what your legacy, what you would like it to look like, and lots of different variables just as a number itself. But also when we take into account that we want it to help represent what we will be able to access in capital, what we will be able to access in a cash value of the policy for our need for finance, we'll know more about how we want that number to be, and I just don't think that it's going to be anything other than big and bigger. So when we realize that we want a high cash value policy for the purpose of banking, which means that we start by getting an appropriate death benefit, that there certainly are riders then that can be attached to that policy. So a big part of the flexibility of a policy is going to be with a paid up additions rider. Now, what that rider does is it allows you to buy paid up additional insurance. Now, that particular part of the policy will not garner as much death benefit, respectively, as the base part of the policy. So the two parts I'm talking about so far are the policy itself. The base is commonly referred to as the base in the industry. This is the base part of the policy, where premium dollars buy death benefit, and a paid up additions rider can be attached to that policy for a set amount of time for the life of the policy. So there's a lot of flexibility there. That's pointing to the flexibility right there. And when I talk about that portion of a policy with prospective clients and clients, I always ask the question, because again, I'm promoting the idea that you should become your own banker. I want you to be knowledgeable and informed about this idea, about this concept, so that you can be your own banker. And I will ask clients or prospective clients, how long would they like the contractual right to be able to put capital into an entity that they own and control, that will then therefore have the ability to buy paid up additions into the future at no cost of acquisition to them, for one thing. How long would they like to be able to put their dollars into an entity that they own and control into the future? And I don't think that will normally diminish. Our need for finance and our need for death benefit are only going to grow into the future. As a household, as a business, as an investor, that should only ever grow into the future. So that paid up additions rider is the most commonly used rider to attach to a policy. So then you have the base part and portion of a policy that is what you would call run-of-the-mill. It's the standard form of a whole life policy, a permanent whole life policy. And the paid up additions rider can be attached, of course, to the policy that will allow you to add more death benefit, allow you to pay more premium dollars for additional death benefit. But it's also the paid up additions rider that allows you to add the higher cash value to a policy. So the capitalization phase that Nash talks about in his book, Becoming Your Own Banker, principally takes place, as far as policies themselves are concerned, because of the base portion of a policy. The paid up additions will have a high cash value accessible to the owner virtually immediately, right away. And by immediately, I could be talking about within 30 days of a policy going into force. The high cash value that could be accessible to the owner would be because of the paid up additions rider part of the policy. While the policy in general will be capitalizing, and on the point of capitalization, Nash said in his book that it should be right at 7 years or more, at least 7 years or more, that we should be capitalizing our system. Because if we could look at our need for finance, we're going to be talking about several years anyway. But not only that, just like he mentioned in the grocery store, that we shouldn't be the only customer, the only consumer at our grocery store. Well, don't we have children? Don't we have parents? Don't we have so there are other folks within our financial footprint that would benefit as customers, consumers of this privatized banking system, of this grocery store, if you will. So that paid up additions rider allows us to have high cash value. It buys additional death benefit into the future. It gives us a larger warehouse in general to be able to amass our capital, to be able to warehouse it, to be able to capitalize, to bank it. And certainly there are other potential riders. There are several other riders. I won't go too deep into that right now. There may be a case in a one-on-one discussion, obviously, as you're vetting this idea and getting informed and working through our process to become a client, where we would figure out what would best meet your needs, of course, in your individual situation. And that's true with everything that I'm saying now about policies and their structure and the flexibility of these infinite banking style policies. I do not have a cookie cutter approach. We do not have a cookie cutter approach to the infinite banking. You are very different from me, very different from Nash, very different from someone else. We need to be looking at your specific situation and structuring policies that will be flexible to your needs of finance immediately, starting right out of the gate, but that will also service you well long range. And by long range, I mean intergenerationally. So in general, what we're going to see is that there are obligational parts to a policy. That's true. To maintain a policy in force, you would have to pay premiums. We have to be able to get past the idea of paying premiums and for sure paying the kinds of premiums that would make an impact into your need of finance. We're not simply talking about getting the basest and most meager of coverages, okay, that are also going to allow us to have a high cash value to be able to provide for our need of finance. So we have to be able to look past paying premiums. We have to be able to look past paying significant premiums, meaning significant for you. You know, when I got started, it might have been high or low compared to someone else, but for me, even with my very first policy, it was a significant amount of premium that I was paying in comparison to what I was earning on an annual basis at that time. And that's only continued to grow and to scale. So when we get past capitalizing and paying premiums, we do recognize that, yes, there's an obligatory part of a policy where we must pay premiums to keep that policy in force. You know, it's a unilateral contract with the insurance company where when we pay premiums, the impetus is on the insurance company now to use that money well, to provide us with that death benefit, to do well on their contractual relationship with us to provide cash value, that death benefit, and everything that is in the contract itself. But there's also a lot of rights within that contract where we can make policy loans in a known interest environment where we can be well aware of what our guaranteed growth is in the policy and everything else that will be laid out in the contract. So right off the bat, I can say that a lot of the flexibility in a policy is if, for whatever reason, war, government shutdown, pandemic, recession, depression, highs, lows, boom, bust, for whatever reason, and whether that's at a national level or at a personal level, a lot of the flexibility can come in that if an individual has a bad month, a bad 3 months, or whatever the case may be, the options begin to start looking like this. If there is an inability to pay as much as you would like into a policy, as much as you have a contractual right to be able to pay in, and for whatever reason, you need to run a tight ship through a bad month, through a bad 3 months, a season of life, whatever the case may be, you can still keep your policy in force by paying base premiums and foregoing temporarily of paying the full amount of capital that you would like to in your privatized system. You don't have to pay that full amount. That is your contractual right to do so or not to do so. So there's a lot of flexibility right there. Because in general, the amount of contractual right to pay is going to be much larger than the amount that is obligatory. Meaning that the obligational part of a full premium is going to be a smaller percentage in comparison to the amount that you should be able to pay into your policy by right. So along with having the flexibility to only pay for a period of time, if that's what your need is, the base premium and forego paying a full paid up additions portion of your policy. You also have the option of using your dividend for different selections. Of course, the one that I promote the most is that your dividend be used to buy paid up additional insurance. That way you have an ever increasing death benefit, which also therefore means that you have an ever increasing cash value. However, that flexibility is there for you to be able to use, and you can get that in a check. The insurance company can write you a check for your dividend every year. And of course, again, I endorse buying paid up additions, but that dividend can also be used to offset the cost of your premiums. That's part of the flexibility of having a policy. There's also reduced paid up, which I don't want to talk too much about. It's good to be aware that you could have a paid up policy and your premiums be reduced in that way. However, I think, again, let me preface by saying that if a policy's been structured correctly from the start, from the beginning, meaning you're not trying to go to your local box store agent and coach them up on how to properly structure a policy, they're not going to know. Most home office folks of the same companies that we would use to buy these policies from don't know. And Nash says that in his book. So that points back to imagination again. But the flexibility is there for you to pay base premium only, forego paying temporarily to the paid up additions until you are able to fund the paid up additions the way that you would want. You can use your dividend for different options, also including offsetting the cost of your premium. You can convert your policy to a paid up additions policy. That's incontrovertible. You couldn't turn that around. You couldn't change that once it's reduced paid up. It is reduced paid up. So that's why I don't speak about it too much, because again, I believe that if you know what's going on, you'll know what to do, and that won't probably be the option that somebody would want as you're cognitively building a system of policies around you to provide for your need of finance. Also, you can use your cash value that's in your policy to pay premiums in the future. Meaning, if you've had a period of time, obviously, where you've been able to fully fund a particular policy, meaning that you paid the full amount, that would not mech the policy, that would not change its tax treatment as an entity. It would not turn it into a modified endowment contract, but you just have fully funded the policy. And you have cash value that is built up. You have capital that's built up in that policy. If in the future you hit a bad month, quarter, year, whatever the case may be, you can borrow from the cash value. You can use your money to keep in force that same entity that you own and control. So that's a beautiful option as well. Again, that points to the flexibility of a policy structured this way, that you can use your cash value to pay premiums in the future. And there very well may be a time where you strategically plan that to be the case, that you've paid for several years into your policy and that you use the cash value to be able to pay that policy in the future. Because again, by the time that you see what your dividends are, depending on what you're using your cash values for, that may be the best purpose that you decide upon, that you use the cash value to pay the premiums into the future after having funded and capitalized that policy after several years. Another option that you may have is, as you're building a system of policies, and I'm not necessarily endorsing this, and I definitely do not believe that it's the place to start right away in the very beginning. But again, just being aware of, just knowing what your options are, just being cognizant of the flexibility of what it means to build a system of policies that you own and control. You could also use, just like you can use the cash value in one policy to pay its premiums in the future, you could also, in the need or desire, again, as long as you have a plan, I think that's the difference. As long as you are aware of what the repercussions of your choices mean by using cash values, what I'm saying, to fund another policy's premiums for a given time, as long as you're aware of what that means, that you're using capital from policy A to pay premiums for policy B, just like I would say, don't steal the peas, don't borrow from the cash value without having a plan for anything, whether that's financing a vehicle or taking vacations or what have you, any investing that you're doing. Just like you should have a plan, you should be honest banker. That's one of Nash's core principles. Again, I believe that it's a beautiful thing to be aware of the ability that you have as your own banker to be able to have one branch support another branch in the need that is necessary. So that's called laddering, stacking. There are other terms in the industry, the footprint of infinite banking, where that is used. But that is another flexible option that you would have as the owner of a system of policies. And ultimately, remember that you have a cash value in a policy because it is an appreciating asset. From the moment that that policy is in force, you should know that not everyone can get a policy such as that for whatever health reasons there may be. It should be known that there is a market for whole life, permanent life insurance, especially policies that are structured this way because of their inherent high cash value, the structure of that policy. Especially for folks, for whatever health reasons, aren't able to obtain insurance on themselves, there's a market for them to obtain insurance. Now, as far as selling your mortality goes, I'm not endorsing that, but I am saying that there are those out there who can obtain insurance for themselves that would be happy to obtain insurance for themselves, even if it means that it's on another person, because of the tool, because of the asset, the appreciating asset that it is. In the event of your passing, there would be a tax-free transfer of wealth to someone's beneficiaries, the then owner of that policy. But also there would be the access to cash values today for whatever their purposes may be. So there is a market for whole life insurance. I'm not advising anybody to be actively selling their mortality, and in fact that would be a detriment in many different ways. It goes against the inherent nature of insurance, which is for you to be able to offset your risk for the benefit of family and such, those that you care about. And insurance companies pay attention to that. So I want you to be very aware of that. And yet it's necessary to note that a policy is an appreciating asset, and that it therefore has a surrender value, because if the company is promised contractually, bindingly, legally, to pay a future death benefit, that also means that they would be willing to pay a surrender value now if you were to decide to free them from that future obligation. There's a surrender value to the policy. And that would be, the cash value minus any outstanding loans at that time. But once you understand, so I'm mentioning that knowing full and well that once you understand how a policy works, that should never be the case. I've never procured a policy for myself with the intent of surrendering that policy. And with all of the other flexibilities that I've described here, I just don't see how that would realistically be the only choice that an owner of a policy would have to be able to weather a storm, let's say, especially if we've been prudently practicing and not over leveraging ourselves and not undercapitalizing our policies. We should be better positioned than most. So in fact, as far as a market for policies go, I would actually have to say that personally, I would be in the market for whole life insurance with a mutual company that's been properly structured. I am an active purchaser of whole life policies. I've bought several policies, of course, for myself, my wife, and we are actively buying in. We will be actively buying into the future. So If you're vetting this idea, be aware of how valuable an appreciating asset, a permanent asset is, that has no market volatility, that's a hedge against inflation, that has tax-deferred and tax-free advantages to it, and lots of other things. As an appreciating asset, there is a market out there. I'm in that market. I'm always trying to add to my system over the course of years. After having discovered this idea in 2015, my wife and I have bought multiple policies. In fact, we have some in underwriting at the time of this recording, and we plan to buy as many as we can into the future as we provide for our need for finance to be able to captivate 100% of what is our need of finance in our financial footprint intergenerationally. So I'm in the market. So if you're vetting this idea, be aware of that. If you're a client and you've got your first policy, it's not my practice as a professional to be buying policies that I've written for someone else. But be aware of what the value is of such a policy. So along with all of the benefits that we have in owning a privatized banking system that is built of these policies with a mutual company that pay a dividend, there are many, many characteristics that I talk about on this channel that Nash talked about in his book on policies such as these. Flexibility is not the least of those. From the start, when a policy can be constructed to provide for your immediate need of finance in some way, right away, right off the bat, you can begin practicing the infinite banking concept for your need for finance. But also knowing that policy, you should know, you should be educated in a way to see, and that's why that policy would be built in a particular way for you, the individual, that it would satisfy your needs of finance into the future in thinking long range, intergenerationally, very long range. The flexibility then, from the moment that policy goes in force, is in your hands. You have the ability to run a maintenance and only pay the obligational part of a policy if you need to forego fully funding, fully capitalizing your system in a particular month, in a particular year. We've had some wild times here recently, politically, economically, and whatnot. However, just to be clear, the cash values in my policies have grown every day over the past year, on weekends, holidays, when the markets have been closed, with government shutdowns, pandemics, etc. I'll leave it at that. My cash values have grown every day, over every day, for the past 12 months. But all the same, if you hit a time where you need to just keep a policy in force and not fully fund it till you get through a storm, then you go back to fully funding it as you anticipated and had the contractual right to be able to do so. Also know that the dividends that you earn provide you a lot of flexibility as it concerns your policy. You, as the owner of the policy, get to decide what that dividend goes to. Also, you can use the cash values in a policy to pay premiums on that policy into the future, premiums on another policy that's in your system into the future, and you have lots of other options that are non-surrender options. So to know more about the flexibility of how we can construct a policy for your needs both now and into the future and carry this conversation on, you can reach me at 828-817-4223, or you can email durhamtalents@gmail.com. I hope that this has been helpful. Let me know the highlight for you down in the comments, and I look forward to our next conversation. Have a great day. Take care. That doggone thing has been dropping. Me.